Today I want to talk about how a number of funds are having a fire sale, dumping their assets and purposefully crashing the market further, and how this will lead to the mother of all short squeezes for AMC. So stay tuned and let's make some money. And I want to dive straight in with the key information. So, Pete tweeted saying Goldman are ripping UK pension funds trying to offload their private assets with up to a 30% discount to book values. He said, "I've said for years that private assets will give an illusion of price stability until you want to sell them." This article says that Goldman Sachs is among a number of investors looking to buy private assets from UK pension funds. And an executive at Goldman Sachs said we're seeing discounts of 20 to 30% for a high quality portfolio of stakes in private equity funds. Now, I think this is really important for a number of different reasons. We've got UK pension funds trying to privately sell their assets to other banks and other institutions. Now, this is important because it means these pension funds don't want to sell their assets in the public market, because obviously selling this kind of volume of assets would crash the market. Therefore, they're willing to sell their entire portfolio at a discount to other private investors. Now, what else is also telling here is these other investors and major banks know that these assets aren't even worth their face value, and they're not even really worth it at a 20 or 30% discount. The reason why Goldman Sachs and other major banks are buying these portfolios of pension fund assets is because they need to buy them to save the market. If they allow these assets to be dumped into the open market, it will crash the market by 30%, 40%, or even 50%. And therefore they're willing to buy these assets at a 20 or 30% discount, even though it's not even really worth that, just to save the market. But I think importantly it shows these UK pension funds are willing to sell their assets at a 20 or 30% discount rather than selling them into the open market, because they think they can get more that way as it avoids crashing the market. But it also says that risk gauges in Germany's government debt market rose last week to levels higher than in 2008, as margin calls forced the liquidation of derivatives positions held by banks, insurers, and pension funds. Now, this is also really important because we're already seeing margin calls starting to happen in these derivative positions. We know that a number of these major banks are holding very over-leveraged derivative positions such as call and put options, total return swaps, and other forms of derivatives. But we're already seeing these derivative positions starting to incur margin calls. And it says real yields, namely the yield on inflation index government bonds, went deeply into negative numbers in Germany and the UK, followed by the US market. It said that pulled the rug from under insurance companies and pension funds, which invest pension payments and insurance premiums to provide for future income. And a portfolio manager at one of Germany's largest insurance companies said that it's a global margin call, and I hope that we survive. So because these bonds are skyrocketing, it's causing a massive dramatic effect on banks, insurers, and pension funds' margin position or their available cash position. This is therefore causing them to incur margin calls, meaning they're being forced to sell off their assets. When a pension fund, a bank, or an insurance fund ends up getting margin called and they can't afford to meet that margin call payment, they end up being liquidated. But obviously these giant liquidations would crash the stock market, and therefore these pension funds are trying to sell their entire portfolio privately to other major banks. These major banks are buying these portfolios at a discount, but not even a good enough discount, simply to save the stock market. But obviously all that's happening here is banks are overpaying for assets that are going to continue falling in price, and therefore it won't be long until some of these major banks end up being margin called as well. And when these major banks like Credit Suisse, Deutsche Bank and UBS can't afford to meet their margin call payments, they will be liquidated and all of these assets will flood into the public markets. And when that happens, these stocks will crash 20, 30, 40, 50% or even further from their current positions. And obviously such a massive crash in the stock market would cause a wide wave of liquidations, causing the AMC squeeze. And believe it or not, Bank of America is already saying that margin calls will start showing up once the SPX breaks 3,600 points or when the S&P 500 breaks 360, forcing liquidations. Guys, if you haven't already, be sure to sign up to MooMoo right now using the link in the description below. You can currently get 15 free shares worth up to a whopping total of $30,000. MooMoo also doesn't accept payment for order flow. They don't route your trades through Citadel or through Apex brokers because they don't sell your order flow. Therefore, MooMoo is brilliant for buying those AMC, those GameStop and those Ape shares, and MooMoo is very easy to use and very customizable. The S&P 500 closed this week just above 360 points, and while it did dip below 360 down to 357 the other week, it didn't close below 360 for a number of days in a row. Margin calls only happen when the S&P 500 closes below 360 for a full week or 2 weeks consistently, and these hedge funds cannot afford to meet their margin calls. Because obviously these hedge funds are given a week or two of leeway to meet their margin calls without being liquidated. But obviously when the S&P 500 continues closing below 360 points, or when the SPX closes below 3,600, it will force liquidations. And I think to show just how close Credit Suisse are to being liquidated, they're already starting to sell off their assets, but they're trying not to sell off stocks, they're trying to sell physical assets. Gold Telegraph tweeted saying that Credit Suisse is now selling a 5-star hotel in Zurich for as much as 400 million Swiss francs. They said a top executive recently said they had a strong capital and liquidity position, but now they're selling a 184-year-old hotel for 400 million francs. This clearly shows they are struggling and they don't have a strong capital and liquidity position, but they don't want to dump their stocks causing a market crash. They're more willing to sell physical assets. But again, they're not just selling a 400 million Swiss franc hotel, they're also trying to sell off their Credit Suisse headquarters for 1.3 billion euros. But as Wall Street Silver tweeted, the sale of the Credit Suisse headquarters for 1.3 billion euros has reportedly fallen through. They said it looks as if Credit Suisse is in a desperate need to raise cash. Will they sell the office furniture next? Credit Suisse are clearly desperate for cash, but they know they can't sell off their stocks as it would cause this market crash and instant AMC squeeze, and therefore they're turning to selling physical assets first. But obviously when they run out of physical assets to sell or the sale of these assets falls through, they will be forced to sell off their shares. Now we know that Credit Suisse still has an open AMC and GameStop short position, likely through total return swaps that used to belong to Archegos, and therefore when Credit Suisse is forced to sell off their shares and their stocks, they'll also be forced to close out of their short positions. Now obviously a major bank or a major institution like Credit Suisse closing out of billions of dollars worth of AMC shorts will cause the AMC squeeze. And Nick Gurley tweeted saying $80 trillion is the combined value of US housing and the stock market. But the United States only has a $25 trillion gross domestic produce or GDP. And this chart he's saying shows there's a lot of wealth destruction still left to go. Now I don't believe that asset prices needs to fall all the way back down to GDP, as asset prices aren't the same as GDP, but it does look very, very overextended over the last few years and looks like it needs a return to the mean. And he said what's amazing is that even with the stock crash and the start of the housing correction, asset values are still 319% of GDP today. He said while that's down from its early 2022 highs, it's still above the peak of the 2007 and 2008 bubbles. Therefore, even though the asset and property market bubbles are starting to deflate, they are still larger than the bubbles in 2007, 2008 and the year 2000. And he said simply to get back to a normal level of asset prices to GDP, we need a further 40% combined correction in housing and stocks. And it seems this is also supported by previous recessions as well. If we look at this chart showing S&P 500 intra-year declines versus full-year calendar returns, we can see that in 2008, the market bottomed around 49% down from its highs. So far this year, at its peak, the S&P 500 is only down around 25% from the highs, and therefore we likely still have another 25% to go. Therefore, at a maximum, we're likely only halfway through the current market crash. Now obviously if the current market crash is worse than the 2008 market crash, which it likely will be as the asset bubbles are still larger than they were back in 2008, the market could fall even further than down 50%. But guys, I finally wanted to give you some confirmation bias or some words of encouragement about the AMC squeeze from a top Wall Street trader. Now obviously this is some trust me bro information as there's no real source provided, but I think at this point everybody could do with some words of encouragement just to reinforce that we are right and that AMC will squeeze. This user said, my only question is, do you think the MOAS will really happen? And he said, the reason I ask is that my dad is a really experienced trader and believes we absolutely have them by the balls, but in his opinion, Wall Street never loses. This user followed up by saying, as a very experienced trader and as an ex-Wall Street banker, we absolutely have them by the balls. He said, there is no doubt in my mind that we do cause the mother of all short squeezes. He said, did Lehman Brothers win back in 2008? He said, never has there been such a unique series of events that have confounded into Wall Street getting caught with their pants down. Never has there been such an educated group of investors who don't fall for psychological trading tricks. He said they're caught between two walls closing in. It's literally impossible for them to close the shorts and get out alive, and the other side being GameStop and AMC heading towards profitability and dividend issuance. So therefore, even though there's no source provided, this Wall Street trader believes that we are right and that AMC will cause the mother of all short squeezes. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.